So what this panel is going to do is examine how the asset class is working in this region. We also have an international panelist as well, so we're going to draw some comparisons. But in the first instance, I would like our panelists, starting with Dino at the end, to introduce themselves and talk a little bit about their businesses in relation to private credit assets.
Okay, hi, good afternoon, everyone. My name is Dino Kronfol. I'm the Chief Investment Officer for Franklin Templeton's fixed income business in the region. I've been in Dubai since 2000 and involved in the public debt markets and now more recently in the private credit markets.
Omar.
Good afternoon, everyone. I'm Omar Yawer with Ruya Partners. We're the region's first and only partner-owned private credit firm based out of ADGM Abu Dhabi. We launched in 2020 with the help of our partners, Mubadala Capital, anchoring us, and since then have grown with other sovereign wealth funds from particularly Saudi and UAE to help facilitate loans to mid-market lending in the Middle East.
Good afternoon, everyone. My name is Amanjit. I'm a financial services group partner at Dechert. I've been in the region for 14 years, so I'm here to talk about the legal side of the changes we've seen in the private credit space.
Good afternoon, Matthias Avellinia Capital out of London. We're a private debt fund and we specialize in asset-based lending.
Thank you, everyone. So, Dino, starting with you, as we all know, a relatively young asset class, but could you maybe outline what you see as the opportunities to investors, especially in this region?
Yeah, I mean, the asset class is young, but it's been extremely effective in both disintermediating the banks in the US since the financial crisis and delivering attractive returns, particularly income. We see the opportunity as an enormous one in the region because we also, in my mind, suffer also from this dominating kind of commercial bank presence. We rely on them for so much. But we think that's about to change. And when we think about just the opportunity, historically, emerging markets tend to represent about 20 to 30% of global markets. So if we just do a back of the envelope calculation, and you look at a $2 trillion global credit market, you think emerging markets can be maybe 20, 25% of that. And the GCC is historically about 20% of that. We're looking at the potential for a $40 billion market. So that's just an enormous, I think, opportunity for the private sector as well as the private sector to participate in. But having been here for a very long time and having launched one of the first even public debt funds in the region, I would caution that just because the opportunity is there and it's enormous, it doesn't necessarily, it's not always realized unless we get all the different stakeholders to participate in developing that market. So looking forward to this conversation today to see how we do that.
Thanks, Dino. And moving on to Omar, we were speaking earlier, you're going to be shortly closing a fund. So obviously you've been on the road, you've been seeing what's out there. Could you maybe tell me what investors are saying to you and what they're looking forward to in investing with you?
Sure, thank you very much. So private credit in the Middle East, we're really just at the starting phase. To give you an idea, while all the sovereigns and pensions and endowments in the region have been investing in credit globally, the last 3 years represents the first time they're actually looking inward, particularly in UAE and Saudi, for GPs that are based particularly either in Saudi or Dubai, Saudi or UAE, to actually back us. And the reason they're doing that is because the visionary plans of Saudi and UAE required that the middle class to grow significantly, more than 10% from a GDP contribution perspective. To do that, they either rely on the banks to give financing to these mid-market companies, which they're not doing, or for folks like us to focus on that segment. And one of the things to demystify to particularly the allocators first and to the audience second is the fact that we are able to generate 15 to 18% worth of returns without using leverage. That's quite significant relative to our peers in the West who are in developed markets that are doing sponsor-led deals. This region is a bilateral region. There's not enough M&A activity for us to piggyback on to help facilitate those transactions. So we do bilateral loans, which means it gives us the ability to not have to use any leverage to get these returns. And we're lending to growing businesses. Getting these types of returns in the West generally goes to lower mid-market. In the Middle East, these are growing businesses, senior secured loans with getting mezz-like returns. That's kind of the eye-opener for a lot of the allocators. They thought these types of returns must mean you're going to companies that are pre-bankruptcy or you're going through distressed and stressed. The reality is the Middle East has such a big funding gap that exists because the banks are only lending to big family groups and government-backed projects. So the middle market has been really left to grow at a turtle-like pace, whereas we're coming in, and folks like Franklin Templeton as well, are coming in to solve for that. And that's kind of what's changed the way that the allocators are changing their way, especially UAE and Saudi. The rest of the GCC, unfortunately, hasn't moved as much to allocate to folks like us, whereas Saudi and UAE has.
And can I just move to Matthias then, because I know you're based in London, but you've been coming to the region for a while now. What are you seeing, and what are you seeing compared to the investors you speak to in the rest of the world?
Yeah, thank you. And maybe taking a step back, I think, where does private credit really come from? It was post the GFC that a lot of banks withdrew from more and more asset classes, and that has its effects in things like the direct lending, so giving larger loans to individual companies, but also other asset classes that were traditionally refinanced by banks, thinking of things like invoice financing, factoring, credit card portfolios, those type of things. Banks have withdrawn and private credit has really stepped in. So this overarching development has really been at the heart of driving the rise of private credit. From our point of view, also what's happened at the same time is at the sort of smaller end of things. On the origination side, a lot of new business models and origination channels have emerged, driven by internet, mobile adoption, open banking, all these sorts of tools that enable originators and lenders to originate, underwrite, structure very small loans, micro loans, both on the consumer but also on the SME side. And in that sense, being able to originate asset portfolios, loan portfolios that banks were never able to originate in the same sense. So all of this has really driven the demand for funding of private credit as an asset class, and the adoption across different regions and across different sub-asset classes. So from our point of view, as I said, private lending or private debt started with direct lending. Now there's other asset classes. With most of these developments we first see in the US, then it moves to, in Europe, the UK is always at the forefront, maybe also because of shared language and shared more philosophies. Then things move to Europe, continental Europe, but also, of course, the rest of the world. And coming to this region, what I'm seeing is, as Omar just pointed out, that direct lending on the non-sponsored side is really at the forefront of private credit here. But we're also seeing from our point of view, and as I said, we're doing asset-based lending, so we are refinancing these fintech portfolios, these non-bank lender portfolios. We are seeing a lot of deal flow compared to the size of the overall market from the region. Some very interesting deals, and in a sense, in a lot of cases, it seems the region will be able to leapfrog some of the developments in the market that we've had in Europe and the US, basically leapfrogging the kind of bank sector and going directly via fintech originators or non-bank lending entities to the underlying LPs.
And Amma, you're here to give sort of an umbrella view of the industry as our resident lawyer, and obviously seeing lots of different investors and also fund managers. So what are you seeing at the moment with regards to opportunities?
So I think just to kind of bridge the gap, I think Omar and Dino mentioned it, and Matthias did too, that there's been a funding gap. So there's opportunity there in terms of growing the private credit space to kind of find alternatives. But I also think from an investor perspective, especially from the region looking outbound, they're looking for diversification. So the traditional asset classes are always there, and they will be, and they'll be prominent. But a lot of the clients that we work with are looking for alternatives, and private credit is one of those, especially when it comes to finding a fixed income type return. So that's where we see a lot of growth, and to kind of cater for that, our sponsor side clients are looking to private credit to kind of fill those gaps and provide more opportunities for it. We still see, to the points Omar and Dina raised, that a lot of the investors regionally are looking outbound because of names and the opportunities of who's offering these types of arrangements. But that's not to say that there's not a shift locally in what is being offered and then what clients are looking for.
Yeah, so I think it's worth highlighting also that in the West, the development of the market was sort of riding on the coattails of the development of private equity. I mean, Matthias, you mentioned the sponsored market. So clearly that is an enormous driver of transactions in Europe and the US. We don't have a very active or scaled private equity market yet. And so, participants in the private credit market do need to think about origination, need to have a presence here, need to navigate the nuances of the region to be able to sort of deploy money. So there still is, I feel, a lot of work that still needs to take place to develop the whole private market ecosystem, including private equity. But we don't have to wait for that to happen to sort of grow private credit. But certainly that would be, I think, an important catalyst to see the market develop further.
Thank you. So what I want to move on to now, and actually I'd like to go back to something that Omar mentioned. And this is some of the myths around private credit, why some people might be reticent to dip their toe in. And when we were discussing this, I thought it was very interesting what you said about the perception that there's leverage embedded in these returns when there actually isn't. Could you just give us a little bit more color around that?
Sure, thank you. Because most of the allocators in the region have been allocating to international managers, so they understand credit from the Western lens. So they were asking initially the same questions they would ask a Western manager without understanding the dynamics of the Middle East. Because there's no sponsor-led activity, not in a big way, we are actually making all our investments bilaterally with these underlying companies that need financing. And when we're able to do that, we're able to generate much better returns than our peers in the West, and the fact that banks here don't give us back leverage on the fund. So if we had it, maybe we would use it. But the reality is the banks here are not equipped yet, at least, to give funds like ourselves the back leverage that they give the Western managers in New York and London. So what happens is they start looking at the net figures without using leverage, especially as interest rates have been up for the last couple of years. They look at what is the actual generation of returns from a manager without using leverage. And they compare us now to the West, and they realize, well, actually generating double the returns of a Western manager without using any leverage. That's the aha moment that allocators have been seeing, that they say, well, maybe let's do some due diligence on that. The challenge, on the other hand, despite having an interesting risk-return dynamic, is because as a first-time manager in a region that's finally opening up to private credit regionally, the due diligence time for these large allocators is a lot longer than they would in making decisions for a Western manager. So instead of a 3-month decision time, it's probably a year and upward. Instead of their own internal teams only doing due diligence, it's internal teams as well as the likes of Mercer, Axia, and others to do due diligence. But the good news is that once that hurdle is passed, I think the next round for us, the next round isn't for all the ecosystem in the next 4 or 5 years, is going to be a quite significant one as other large allocators start opening up to private credit regionally. Because they're going to start realizing that we all live in this region. And for us to not participate in this growth cycle, forget about a token investment in this. Don't do it because we're just based here. Do it because from a return perspective, it makes sense for your asset allocation model. Yeah. And it does.
And it's not just, not just sort of the experience you have, but even if you look at things objectively compared to, say, the public markets, the public markets have grown to over $1 trillion today. And they're very efficient. If tomorrow Mubadala or Aramco wants to borrow $5-6 billion, they can do that very efficiently. The spread, on the other hand, when you look at private markets, you're looking at 5-6x what you would expect in the public market. So there's also a real incentive to invest and sort of capture that liquidity premium that you otherwise wouldn't.
And Amma, what are you seeing as sort of reticent signals from people you speak to in the region about private credit?
Yeah, so I think just touching on a couple of the points, I think the largest thing is there's this misconception about the legal and regulatory framework maybe not being on par with the Western markets. And I think for a long time maybe that was the case, but I'd say now that the markets are more developed, the regulatory and legal frameworks are definitely competing with, if not kind of moving ahead of other markets. And the security that the region provides from at the lower level when you're actually doing the borrowing, like with the obligors, I think people are a bit scared about, well, what security do we have? Are we secured? And the answer is yes. The infrastructure is there. The policymakers in the region have moved ahead quite significantly to ensure that these misconceptions are dealt with. And they, like the Ministry of Economy representative earlier said, that they are able to change and adapt and react to people in the market saying that, well, this isn't what we expect, or this isn't how it should work compared to Western markets, and actually react faster and are able to implement change quicker. And we're seeing that across the legal framework, where new laws, regulations are put in place to deal with and move the market forward.
I can't thank you enough for saying that, because when we say it, people look at us and say we're not lawyers and we're not entitled to say that. But I think that message needs to come across. And I would also add maybe something that supports that as well. Part of the reason I think the legal advice and the work we do with lawyers is so effective is because, again, Omar talked about the financing gap. Well, one of the consequences of that is that you're able to extract so much in terms of security and credit control that you wouldn't otherwise have. I mean, the US is a competitive market. You're up against 4, 5, 10 people for any particular transaction. We don't have that, and we're able to kind of input these measures, credit control, security, which are very effective. And we do have the legal infrastructure today, and we do have the advice to be able to really isolate and capture the risks we want to take, and then try to offload the ones we don't. So, that to me is no longer a hurdle preventing. I mean, it's an important consideration for sure, but it shouldn't stop investors from investing in this space.
And Matthias, when we were discussing this, you were making the comparisons about how the UAE is. It's got a lot of different countries and different perspectives, in the same way that Europe is not just one big region. There's lots of different regulations across different countries, and how that impacts people's ability to invest and what they think about things.
Yeah, no, I mean, coming from Europe and people from outside of Europe, especially, the US perspective is always like, oh, it's one big market, and there's not a lot of regional differences. And when you then actually look at it, especially in the world of lending, regulation, local enforcement of securities, bankruptcy regimes, etc. Despite being a single market on paper, there are still a lot of regional differences or country-specific differences. So it's always very important to really know the region and the individual countries and adapt to that. And it's obviously it's going to be the same in the GCC as in the EU. It's from the outside it looks like a big market, but from the reality on the ground is that there are stark differences. But I also wanted to quickly come back to the point that Omar was making about the high returns and LPs trying to understand, like, is this very risky? Is this riskier than the same deal that I get elsewhere, where that only pays half of it? We're facing the same questions and the same kind of underlying skepticism as in our asset class. Why? Because it's relatively new. It's a bit complex, and you're a first mover, so you have to explain to people the reason that the returns are high, and we're generating on what are loans secured against diversified portfolios of financial assets, the senior portion of it. So it's not risk-free, of course, but it's a very good risk-reward trade, in my opinion. We're generating mid-teen returns. And people are saying, oh, this must be very risky, especially in very traditional markets. Like if you talk to an insurance company in Germany, they say, well, it sounds nice what you're doing, but the returns are so high, come back when they're lower. Okay, well, we'll do that. We come also, then we can come back in bigger size. So that might be the flip side of the argument, is that what you're currently doing here, the deals aren't as big as they are elsewhere in sort of more developed either markets or asset classes, and that's why you get the high returns. There's a first mover advantage. There's less competition. There's some complexity. There's of course illiquidity if you compare to other asset classes. So all these are reasons that are driving the return rather than a pure risk perspective.
Thanks, Matthias. And I want to stay with you for the next question. The commentators talk about the golden age of private credit, but when I speak to some of our manager members in that space, asset raising has been a challenge. So do you think you could touch a little bit on what you're seeing and hopefully what people have got to look forward to in the asset raising arena? Matthias.
Yeah. I mean, the landscape has really very much changed over the last 5 years or so, I would say. Interestingly, of course, when COVID first hit, we were going into the raise of one of our funds, and we were very worried about how is this going to impact it. And then, as everybody knows, because the whole market from all sides was flooded with liquidity, LPs were very keen to allocate. So there was a good capital raising environment across different asset classes. Then, of course, the hangover came and things sort of fell off a cliff. We had inflation, we had rates going up. LPs had a lot of trouble in other parts of their portfolio at different points in time on the liquid side when the stock market came down, and then on the private side with VC and PE portfolios that didn't repay as expected, that got extended, which led to liquidity issues on the allocator side, which in turn meant that they had less money to allocate to new strategies, to new funds, etc. So that was really the landscape over the last 3 to 4 years. What we found, and even kind of last year, was still very difficult fundraising environment. And in my view, that has changed with this year. People are a lot more open. They have money to allocate again. The whole economic backdrop is a lot more stable. The view forward is a lot clearer. But having said that, you never know what's around the corner. But people are starting to allocate again, and the fundraising environment, in my view, has improved a lot.
Amma, what are you seeing from your clients?
So I think, again, touching on something Dina said, there's a lot of competition. So we are still seeing a lot more outbound in the private credit space, but I think that's also countered with what, going back to a point I made earlier about what policymakers are trying to do to therefore kind of deal with that and attract people to the region. And I think like in the ADGM and DIFC over the last few years, the private credit fund regimes have been put in place, and even earlier this year, there's been kind of a call to evidence in the DIFC where they're asking for feedback about what those regimes look like and whether the terms that are within those regulatory frameworks, they align with what other market leaders are providing in that space. So I think there's a shift to try to attract more to the region, and hopefully that competition and bringing kind of more market terms to the region will help a lot of the kind of regional fund managers who are trying to raise and money regionally and keep it in the region.
That's hope, but hope is not a good strategy. The reality is, I mean, you have $5 trillion of reserves in the region. It's one of the, it's one of the things we're famous for at the moment, and one of the, I think very important things underpinning the credit environment in the region. But because of that, the competition's enormous. Everyone is here looking to tap into that. And also the pressure on these sovereign wealth funds to deploy significant sums is also increasing. So it makes people that are offering regional products less of a priority. And these are the challenges I think we will continue to deal with. I mean, we were first to launch one of the first Sukuk funds, one of the first public debt funds in the region. So we're not under any illusions of the challenge that lies before us. But, these are, they may be difficult and long-term journeys, but they will be rewarding to both the investors as well as the product providers. But it does require, I think, patience, commitment, and it will take some time for sure.
Omar, I'm sure you've got a lot of opinions of that, seeing as you're kind of in the midst of a raise at the moment.
Yeah, look, especially as a first-time fund, you're trying to balance various fund closings with the timing of investors allocating more money and making deals as you go along. So we've invested 30% of our fund before our final close, and we have a couple more deals this year. So it's quite of a challenge as a first-time fund and in the region. The interesting part of the story, to add to it, that has helped speed up the due diligence process for folks, is the fact that international managers are coming in here, no longer just setting up offices for fundraising, they're actually opening up to particularly tackle private credit. You've seen headlines with large allocators, large firms like JP Morgan and Goldman doing Tabby and Tamara. Frank and Templeton, obviously, in this space now. You heard Janice Henderson acquired our old previous firm, NBK Capital. So they're obviously seeing something that we've been kind of drumming about for the last 4 years in our fundraise journey. When you start seeing large allocators saying, hold on a minute, there's something to be had here. The allocators that are looking at us kind of say, well, maybe our thesis is right. The allocators who haven't had an allocation to private credit regionally start thinking, maybe it's a 2024 story. So there's a nice shift that's happening kind of between the lines. You have to read between the lines and say, well, there is real opportunity set. It's not just on venture debt side, it's actual mid-market, because the mid-market needs to grow to achieve Vision 2030 and 2040. If it does not, the governments cannot just finance the growth of big companies to be bigger. The middle class has to emerge through alternative financing, and that's why we exist.
Thank you very much. I'm going to move on to our last questions because I'm conscious that we've only got 4 minutes before you go and get your lunch. So final question really, when we're sitting here in 2 to 5 years' time, what do you think the private credit landscape will look like? That's a very general question, but maybe things that are very close to your heart. I'll start off with Matthias and run down the line.
Yeah, I think, if I look how things have evolved over time geographically, starting in the US with a lot of the strategies, the sophistication and understanding of the allocators, then move to UK, Central Europe. I think these cycles of understanding that they've shortened, and what I see for the region here, and that goes back to the points that were just made with so many also international funds moving here, and ultimately also looking to do something in the region that will really speed up the educational process of the LPs and their comfort with investing in the region in private credit. So I think we'll have a much more fully developed ecosystem here in 3 to 5 years' time.
Emma.
Yeah, I think I probably would echo that. I think with managers moving, getting licenses, feet on ground, it would attract more opportunity for a diversification of also the type of private credit we're seeing. At the moment, senior secured direct lending in the region is kind of the most prevalent, but I think that would change and shift in line with what international markets are offering, more in like the BDCs, CLOs, secondaries. So I think the next 3 to 5 years will be really interesting for the private credit space, but I do think it's a growing sector for sure, with everything that's being done to kind of attract the right players.
Thank you, Omar.
I think a couple of things. One, the type of loans will evolve. Right now, it's pretty much all growth financing that's needed because we're in a growth phase. Saudi companies need more money to grow in Saudi. UAE companies need more money to grow in Saudi. So it's a growth story. But as we develop and we continue and the cycle changes, then there's going to be stress and distress of financing needs available. So that's from the supply that's required. The allocators, I think, is going to change quite significantly. One, more sovereigns, pensions allocating regionally. And the other kind of hidden gem is tie-ups with banks. While the banks don't need to necessarily change their stripes fully, they can follow what's happening in the West with banks tying up with private credit GPs to actually help them get better cost of funding and actually distribute faster loans. That makes sense in the West and makes sense here. However, there's kind of right now it's not really going anywhere, that part, where the banks don't really think of a private credit manager as a partner per se. They perhaps see it as a competitor, yet they don't even go to that type of financing. So I think that part of, if it does work out, will make a significant change for the region.
Thank you. And the last word to Dino.
Looking at how markets develop, they start in fits and starts. So it really would depend on, how many people launch, how they actually do over the next couple of years, and from there you can. 3 to 5 years is a relatively short period of time. So I'm optimistic it will grow, but I think in terms of how much it scales up, I think really that's a function of how well the experience is. I mean, you have to recall we had private equity that ended up having a few fraud cases and a few setbacks, which really set back the industry a number of years. I think we're wiser for it today. We have much better regulators, much better market participants. I suspect this will be a much better journey. I think the region is better suited for private credit than private equity. But yes, I think the onus is on, me and Omar and the rest of us to deliver good returns these next few years so we see the asset class grow.
Thank you very much. Thank you to my panelists. Would you please join me?